Well, hello, everybody. Happy New Year to you, and welcome to the first Trend Signal podcast of 2020. This is the trading podcast that gives you a lively run through of the markets, what to look out for, and how to improve your trading. My name is Adrian, and I've been trading the market since 2002, and I'm now head of trading here at Trend Signal. And today I'm going to be joined with Trend Signal's chief market analyst, Jerry Miller, who's going to take us through what to be looking out for the week ahead. Now, in this session, we've got quite a lot to get through. There's a lot of tensions going off in US from the US bombing over in Iran and the Middle East. We're going to talk about how that's impacting the markets. We're going to be looking at the major events coming for the week ahead. We're going to have a look at the major support and resistance levels for crude oil, for gold, and also for the equity markets. And in our defining trading section, we're going to take a look at something called risk on, risk off. So that educational element in there, we're going to go through exactly what that means and what it means and how we apply it to the markets basically as well. What do we know? So in this session, we're going to speak to Jerry Miller, our chief market analyst, who's going to go through a bit about what's happened over the last few days. And let's face it, there's been quite a lot, hasn't there? So Jerry, why don't you kick us off?
Yeah, it's all geopolitics that's been dominating the markets. It's not something that anyone expected at the start of the year, and it literally was, whatever it was, Thursday evening, Friday morning. And I think this week is going to be dominated by what Iran's going to do about this. But for those of you who aren't sure what's gone on, the assassination of a chap called General Soleimani from Iran, who is the second most important politician come general come whatever you want to call him in Iran, and he wielded a lot of power, and the US rather surprisingly assassinated him, and it's basically caused the markets to suffer significant. We had some big moves Friday morning, and the news over the weekend is even more negative.
Yeah. Absolutely. There's been quite a big impact on sort of the stock market and also some of the commodities as well, gold and oil, obviously.
Yeah, oil you'd expect it to fall. Oil had already fallen, got about sort of $3. It's fallen another dollar or so fallen.
I was just thinking, hang on a second.
We're talking about stock markets. Yeah, oil markets, of course, have risen, which of course is exactly what you'd expect. Oil had risen about $3. That's UK oil. I think another dollar or so overnight, which is close to 6%. And I think the threat of an attack on an oil installation is very high at this stage. That's also undermining the stock markets. Let's face it, when the Yemeni attacked the Saudi Arabian plant last year, it had a significant effect on oil supplies and the price of oil, and it's something that the Iranians will probably have as a prime target, I suspect.
Jerry, can you just explain why this situation would lead to a rise in the price of oil?
Okay, yeah. The important thing is because there's likely to be a significant interruption to oil supplies. Even if you have constant demand, if the supplies are cut in any way, that'll lead to a squeeze in prices as people bid for whatever oil there is on the market at that time.
So it's the old classic supply and demand, isn't it, really?
Yeah, which is...
And that's why the Wednesday crude oil inventory numbers are so important, aren't they, when it comes to it? That's sort of our main reading of it, isn't it?
Yeah, I mean, that Energy Information Administration data is really for domestic oil. That's the WTI, the US oil. But if you look at the sort of widely traded Brent oil or UK oil, that has had a significant hit by the Iranian situation.
So the risk of an attack on an oil installation, that sort of the risk of supply being cut, basically makes the price effectively
absolutely spot on
higher.
That's exactly it.
Okay, and what about equities then? So obviously we've seen the S&Ps take quite a hit. We've seen the FTSE come off a bit. Is it as much as we might have thought?
Do you know, it's interesting. I would have expected more of a hit, but when you look at it, the S&Ps. Well, last time I looked, they were down just over 50 points. But you'd expect a bit more on the back of that, though, Adrian. I don't know. For me, it seems a bit muted. But they're falling still, and maybe this is a work in progress, as it were.
It's interesting. I mean, it does feel like it's something that could have legs. This story, doesn't it? And wider implications, really. But it's funny that certainly since 2001, I think the more terrorist activities that tend to happen, the impact on the markets just seems to get less and less.
Yeah,
really.
It definitely does, and they become immune really to these outrages, and I think that's the effect seems to sort of shorten each time these events take place. But I still think it's a big concern to the markets, and anyone who's living and working out in the Middle East, it's a significant risk. And I think they're not going to do anything stupid, the Iranians, because they know they're outnumbered significantly by not just the US but Saudi Arabia and Israel. But they'll do something to disrupt life and threaten life, and it'll happen when it happens, and the markets will not be happy with it. Certainly the oil market, that's for sure.
Yeah, well, go on. And what about gold then? I mean, that's been going through the roof really, isn't it?
Yeah, gold is a typical sort of lightning rod for sort of geopolitical angst, and what's happened over the last 3 days has seen the price of gold jump $50 since the news. But actually it's just part of an escalation or an acceleration in the uptrend in gold that started at the beginning of December, where gold is almost up 9%. And this is partly seasonal, partly a reflection of some of the predictions of what's going to happen to the dollar this year in terms of its weakening perhaps. And obviously the geopolitical angst is the thing that has really hit it. So when there is a disturbance somewhere in the world that threatens markets, etc., gold normally benefits from it, and this is an absolute classic example of that.
Yes, and when I talk about trading our definition of the week, we're going to talk about the whole risk off, risk on thing, just so everyone understands what that terminology actually means. So the idea of, we'll talk about it later, but the idea that when things are a little bit riskier, we tend to move into safer assets, of which gold is seen as one of those, even though it doesn't generate an income or yield or dividend, which is your major bugbear, Jerry. I know this.
Ghastly investment, or can be. No, you have to wait for the price to go up to make any gain on it. Otherwise it costs you to insure it and store it, and it doesn't pay a dividend, unlike regular investments. But there we go. No, it's a classic sort of risk off instrument, along with bonds, and a risk on investment obviously is equities. So when we talk about risk off, investors tend to sell equities, buy bonds, and buy defensive stocks perhaps, and defensive currencies such as the yen and such as the US dollar.
I guess ironically, with the oil price rising, would that mean that stocks are coming off as a result of the tensions, but does that mean that oil stocks could be quite an interesting investment? Yeah. They're more likely to hold off the fall, perhaps more than anything else.
No, well, they can do, but paradoxically the price of oil will underpin oil stocks. But obviously if there's an oil stock that's been hit by any military action in the Middle East, it's not going to benefit from the rise in oil price. So
that's true. So the risk is
so it's a bit of a sort of double-edged sword, really.
Yeah. Perhaps if risk averse, best to stay away from it all altogether.
I'd say for now,
yeah.
Or just go long oil.
Well, there you go. I mean, if the tensions really escalate, then of course there's a lot of upside.
Huge
for the price there, isn't there?
Yeah.
And I'll talk about that a bit later on when we look at the charts. I mean, there's certainly a few pivot points up quite a good chunk north of where we are now that could be attractive. Okay, so what about expectations for the year then, Jerry?
Well, we sort of went through some of these, or a lot of these, on our year-end workshop at Trend Signal. But it's interesting. A lot of people ask those questions, and a lot of economists and investment banks don't really make a big thing about it because it's a bit of a lottery. But the FT has asked the biggest and most influential fund managers of their forecast for 2020, and I think in summary I'd say that the majority don't think that we're going to see a global recession, but they don't expect that spectacular growth really. So unspectacular growth is the description.
Is that because they're long only fund managers?
I just think you've done 29.5 or 28.9% in the S&P last year. It was spectacular. And that was when the Fed cut interest rates. The Fed are not going to do anything like that this year, and I think the chances of any sort of great driver are less. And I think last year the market's priced in what's going to happen this year, if you know what I mean. So there will be no global recession and economies will pick up, but that's already priced in. So I don't know. I think banana skins are probably a little more. The markets are probably more vulnerable to banana skins this year than they were last year, I'd say.
You stepped on one straight away, haven't you?
Well, there we go. Yeah.
Okay, and then so the UK held back a bit by Brexit, but the shackles are off. Perhaps is that going to help us?
Well, there's a feeling that is the case, and certainly the UK had been held back by Brexit and what has been described as a non-functioning Parliament. But I think the general election from December the 12th has clarified a lot of that. The Tories got a resounding victory, and I think it's fairly clear with an 80-seat majority that the government are going to achieve what they want in terms of leaving the EU on the 31st of January. But I think whilst it has underperformed, definitely with the rest of compared to the rest of the G7 stock markets, I don't think it's going to be plain sailing for the UK, because we've now got this trade deal to negotiate with the EU. But I still think that will get done. And to what extent it gets done, we'll wait to see. But I think things are looking a lot more positive for the UK, and I think UK might should outperform this year.
I think one thing I've been sort of thinking about with the trade deal is that if it's not like we're starting from scratch, there is a trade deal already in place with the EU, it's a free trade deal, but actually all it then is a question of is revising the deal we already have rather than starting with a blank sheet of paper. Which is the case with any other country why it might take up to 7 years.
Yeah, but I think the UK have done it correctly. I think when Boris Johnson said it has to be done by the 31st of December 2020, because otherwise these things will run and run and run. And if everyone's got a deadline to work to, there's no reason why it can't be agreed by then. But a lot of the sort of naysayers, the Remainers, would probably say it can't be done. But I think a lot of things are down to will, really. And I think that where there's a will, it'll get done.
There's a lot of interest in it being done, isn't there? Let's face it, so I'm pretty sure they'll find a way.
Yeah.
Okay, and what about the dollar then? What are we thinking about that for the year? What are they saying?
Well, so seasonally the dollar tends to do okay at the start of the year, so it's a tricky bet to short the dollar at the start of this year. But a lot of investment banks are looking for a weaker dollar this year. But it's difficult because when you talk about a weaker dollar, what is it going to weaken against? And the first thing that you can think of is the euro. As to sort of discuss whether is the euro going to strengthen against the dollar. And the problem with the euro now is that it's increasingly being used as what's called a funding currency, funding investments.
What does that mean, Jerry?
It's basically where investors are borrowing in euros because of record low interest rates, and then swapping those euros or selling those euros, and then buying dollars, buying yen, buying sterling. Excuse me. And they're getting better returns with their money by doing that. So there's a flow of funds out of the euro, but you will get times when there's a sudden bout of euro strength, which could see sharp appreciation in the euro versus the dollar. But I think that's one of the negatives against the euro strengthening against the dollar. And if the euro is not going to strengthen against the dollar, then what currencies are? Certainly the Japanese yen, the authorities in Japan will not want to see that happen.
No,
for obvious reasons.
Absolutely. Okay, what about interest rates then and the Fed? I mean, certainly they said it towards the end of last year that they probably wouldn't do anything for a few months.
Well, it was this time last year when everyone thought, that the Fed maybe another 2 hikes in 2019, and what a volte-face there was that happened there. That maybe pressure from Trump. I don't think it's pressure from the numbers. So what in the end happened was that the Fed cut rates 3 times in the second half of last year, and I think now they're on a wait and hold, and the dot plot, which is what the members of the Fed committee, rate setting committee, think will happen this year, is pretty flat. We don't think there's going to be a rate hike or a rate cut for now, so I think they're just going to wait and see what impact those rate cuts have on the US economy.
Okay, and the UK?
UK, wow, well, I think the numbers aren't looking good, but they are historical to the extent that they reflect what has been happening in the last quarter last year. They don't make good reading, but that's Brexit and Parliament not functioning and everything else. And I think now there's been a decisive general election, I think it would be interesting to see how the investment trends play through in the first sort of few months of this year. So I wouldn't rule out anything. I don't think there'll be an interest rate cut unless something happens globally that could cause it. But I think we're an outlier in terms of central bank activity, the UK.
Yeah. Okay. Brilliant. Okay. So let's then move on, shall we? And let's have a look at what we don't know yet. And this is where we can have a quick look at the data, the events, what could be the real drivers really for the week ahead. So Joe, what I'm going to do is just bring up the economic calendar so we can have a look at those items that we can see on the screen if you're watching the cast. So Joe, give us a run through then.
Okay, well, normally the first Friday of the new month or the new year, in this case, is the release of the US unemployment data, but due to the holidays it didn't happen last Friday, although it was a working day. So we've got that this week, although not a lot of data out this week, as you can see. You've actually got the medium impact data as well, and probably the highlight is the flash inflation numbers from the Eurozone on Tuesday. On Monday, I think we got the start of this 3-day debate debating the Brexit withdrawal bill in Parliament. Some people have said it's quite, it's an important event, but of course I think it's a bit of a done deal now because the Tories have got such a majority. So we're not going to talk about that anymore. It's sort of like, well, it's going to happen, and it's not interesting. It was only interesting to the media when there was a chance that another
the votes were being rejected and everything.
And
absolutely,
the government was suffering another.
But that's the point, because all the Conservative MPs, the ones that have been elected, have been signed up on that basis.
Correct.
To the deal. Yeah.
And I think it'll be more than an 80 majority for this deal. That's for sure. And then we get on to Tuesday afternoon for the US. We've got this ISM non-manufacturing data. They curiously call it non-manufacturing. It means services. We have service data out in the UK. In the US they're no different, but they call it non-manufacturing. 54.5 is slightly better than the number published last month for November, but it's interesting because the manufacturing data released last week was surprisingly weak. So the market won't be surprised if they see a weaker number than expected. But anyway,
it's still a growth in it, because 50 is basically it's a no change, isn't it? So anything above 50 is an expanding non-manufacturing PMI number.
That's right. So more than half of the respondents are forecasting an increase in manufacturing or sort of service sector, I should say. So anything above 50 is very positive. Compare that with the Eurozone and the UK, where it's 50.
We looked at Germany. Germany's numbers quite a bit in the last in November, December, didn't we?
Horrendous, and still the tea leaves there don't look good for the German economy.
Yeah, well, ADP then. So we've got that. That's a bit of a precursor for non-farm payroll, isn't it? Usually.
Yeah, it is, and it's incredibly volatile there. But last month they had a figure of 67,000, whereas the Bureau of Labour Statistics had a whopping 266,000. So it sort of doesn't carry as much weight these days because it is a little bit volatile. But it's interesting nevertheless. But even if it's a bad number, I don't think the markets will get too concerned until we get to Friday's number.
Any special focus for the crude oil number on at 3:30 on Wednesday, given the backdrop?
Do you know, it's not going to mean much because of what's going on.
That's bigger, isn't it?
Yeah,
bigger than this data.
Crude oil inventories is a technical thing, and it only affects the US market. And it might be symbolic if there's a drawdown, which will just reflect what's going on. But I think that the geopolitical backdrop is hugely important compared to the oil inventories at the moment.
Yeah. Okay. What else is worth looking out for then?
Do you know, I was looking at probably some of the Aussie data. There's the trade balance and then the retail sales. So that comes out sort of Thursday morning for the Aussie trade balance. But we won't be up at that time. We'll wake up and see the effect that's had on the Aussie dollar, and likewise on Thursday night, Friday morning, we've got their retail sales. And also there's a lot of focus on Australia at the moment with ghastly bushfires ravaging parts of New South Wales and Victoria. Anyway, but otherwise the main event for that part of the week obviously is what we'd mentioned, the non-farm payroll.
Okay, so that's obviously a big number in terms of interest rate decisions. We've talked about that in previous podcasts. Is it likely that being on the 10th of January that the number's going to be perhaps more accurate and less likely to be revised because we're already into the 10th of the month?
Not really. It's because there's been holidays. That's why the data's delayed. And so, but I do think that when you talk about accuracy, I think the 266,000 jobs posted last month for November, that could mean that the 150,000 forecast for this month, I think there might be a few revisions there. So I'd be looking for a slightly lower number. But that said, I don't think it's going to impact the markets much because the Fed is pretty much sort of on hold for now, unless it's outrageously weak, which I don't think it's going to be because we had a pretty good number last month, as I said. So, yeah.
Okay.
And record low unemployment rate of 3.5% doesn't exactly suggest things are going in any way, shape or form in the wrong direction.
Well, quite. And okay, so let's say that, just a bit of education for the newer traders and economists of the world, data comes in, let's say it's at 200,000 instead of 150,000 new jobs created. What would that mean to the dollar? What would you expect that to mean for the dollar?
It caused the dollar to rally, an increase in hirings, an increase in economic activity, pressures interest rates, and that would push the dollar up. And generally, positive news in any country is positive for their currency. And it's not always clear whether it's positive for the stock market, though. It depends how sensitive the market is to the threat of higher rates. But I'd expect it to be positive also for the S&P and the Dow as well.
Yeah. Okay. Brilliant. Great. That's lovely. Thanks very much for that, Jerry. So what should we be trading? So there's a big backdrop at the moment. There's a lot of markets we need to be talking about at the moment. I'm going to talk about why things are moving in the way they are with regards to risk on, risk off when we look at defining trading in just a second. But in this section, I want to have a look through the key markets that are moving right now. We're looking at gold, we can look at oil, we can look at the equity markets as well, just to make sure we know what major levels to be looking at and we know what we should be looking at over the next week to a few weeks' time. So let me just bring my charts in and let's have a look at that. We're going to start off with the gold market. As we talked about there, very much a risk off time at the moment. You can see that by the rally there in gold, particularly since those tensions really started over in the Middle East. A dramatic rise in gold, as you can see, from what, 1530 up to sort of 1575. So back to a $50 rise really since then. A flight to safety, but what really now? Well, look, what I want to do is refer to the weekly chart, and what you have with higher time frames is sort of waves within waves, patterns within patterns, and sometimes by taking a step back you can get a bigger picture of really what's going on. I'm just going to tighten up, just compress the chart a little bit, or get a bit more into the chart, and we can see where we're at right now. Gold now moving to sort of 7-year highs, really, having taken out those highs from September, October last year, 2019. We've taken that level out now, which puts us above these two pivot points here, those green lines at around that sort of 1560, 1563 area there. If we can hold the week out and remain above those levels, then it may well lead the market to push on to higher prices, perhaps an area around that sort of 1750 sort of area there might be the next longer term target. I say longer term target, it's not going to get there in a few days. It will take a few weeks, months and so on. But this number here, that 1563, we found support from it back at the tail end of 11, mid 12. We found an element of support for early 13 as well, 2013 that is. So that number, previously support, will it now end up being resistance? At the moment we've sized through it, we've gapped above it today being Monday. Will we end up tucking back inside? We'll have to see, but certainly that's a big number. Otherwise it looks like the stronger term uptrend is carrying on there, so very much the bias to the buying on gold at the moment, with that longer term trend up. Let's have a look at oil as well. It's obviously been a very topical moment. I'm going to start off by having a look at US oil, so US crude oil, which has also been going up quite dramatically ever since the assassination, the bombing. There really we saw that massive move up there from what was it, the 3rd of January there when the market reopened. Big rise. From there, up $4 or $5 since then. Monthly trend is up, and actually you can see the monthly trend turned up at the end of December, and what was a pretty choppy year for oil, really. No real noticeable trend there, trying to flick around from uptrend to downtrend throughout much of the year, turning to a new uptrend now. So again, what that's leading to is a preference to the buying side on oils there, which kind of makes sense given the political backdrop as well. Having said that, the trend had turned up prior to that happening anyway, so very much a bias towards the upside there. In terms of resistance, well, look, let's have a look at the weekly chart as well then. We can see major sort of resistance around that sort of number now, and in fact if I zoom into that recent high 64.41, we nudged that level on the weekly. We just hit that today, in fact, and just easing back a touch off those highs there from today's candlestick, or this week's candlestick, from those May 19 highs. Major Fibonacci level there, that 64.41 level. If we can take that out, then maybe heading up towards that sort of $74, $75 level. So we'll see where things move over the next few weeks. It really does depend on how things escalate, or if they escalate or don't escalate over in the Middle Eastern area. Let's have a quick look at UK oil. That's Brent crude oil. So bear with me a second while I bring that up. This includes a lot of the oil from that Middle Eastern region, basically. And you can see here again on the weekly chart, very strong uptrend. Been in an uptrend on the weekly for a few months now on the weekly chart there. Not quite at the same resistance levels, so it's certainly lower than the US counterpart, which is already nudging those May highs here. We're sort of, $3 or $4 away from those highs. So, and the natural sucking towards that sort of 73.40 level could be interesting, so we'll keep an eye out for that. So $72, $73 there level looks like where we're going to be heading towards, but again, we'll keep an eye out for that. Certainly, again, the monthly trend has gone up as well, so the bias for both oils, UK and US oil, that's Brent crude and NYMEX crude oil, is both turned up as of the end of December. Okay, and then finally, what I want to have a look at is the FTSE, which is our major stock index here, the FTSE 100. Been some really nice rotations on the daily charts over recent weeks, and you can see the number, the pivot point there, the recent high from the tail end of December, getting around that sort of 76.50 level there. We can see the number which we last hit here back in the end of the summer, well, not the end of the summer, July, nudging that 76.77, that pivot point. See how we've touched that? A bit like that game Whack-A-Mole. We sort of nudged our head above it and then come straight back under, leading to that sell signal, which we're in at the moment. So we are currently short on the FTSE 100 stock index off that level there. Also nudging into resistance on the monthly chart as well. So there is quite a lot of resistance here, and certainly as far as equities are concerned globally, FTSE 100 has very much underperformed those other indexes around the world as well. So keep an eye out for that number there, that 76 sort of 75 level. If we can break through that, you expect higher prices, but for now that's very much keeping a lid on those higher prices. Certainly, in terms of a pullback, where might we be expecting? Well, again, let's look for those support numbers there. Recent resistance, 74.20, 74.10, 74.29. That 74.30 area then could be really interesting. I'd expect that if prices do continue to fall and it gets down to that level, I'd expect us to hold steady for there for at least a few days, maybe bounce, maybe carry on. We'll have to review the market as we get towards that level, but I do certainly expect that 74.20, 74.30 level on the FTSE 100 cash index to be important in the coming weeks or so. So in defining trading, we're going to take a look at one particular trading term. We're going to define and explain it. Simple, really. It usually takes 1 or 2 minutes. And this week's definition is risk on, risk off, which is extremely timely given the situation over in the Middle East at the moment. So there's been a big sort of risk off situation happening in the market. So you're going to hear that term bandied around quite a lot in various media. So let's make sure we really understand what it all means. So risk on or risk off describes changes in investors' risk tolerance and investment behavior. So during times when risk is perceived as low, theory suggests that investors will engage in traditionally higher risk investments, and when risk is perceived as high, investors will look to low risk investments. So that's really what we're seeing at the moment. So with the tensions over in the Middle East and the assassinations out there and what have you, effectively what people are doing is flooding out of, it's a higher risk time. Who knows what might be happening going forward, terrorist activity almost, or whatever it may be. People are flooding out of what's seen as the riskier elements of their investments and then moving into safer investments, or what are perceived to be safer investments. So high risk investments might include stocks generally, and certainly more volatile sectors such as technology, maybe resources, some commodities might be seen as higher risk. I say some commodities because it really depends on the situation at the time. We've seen oil rising, we've seen gold rising, so it's not necessarily the case in this case, but other commodities may be affected. Low risk investments might include bonds, gold, and maybe to a certain extent some more defensive stocks such as utilities there. So defensive, your oil, so your water companies, your gas and electrics, the sort of companies that you have to use day in, day out, week in, week out. They're the stocks that are less likely to be affected to a big movement in the stock market. People are generally going to flood out of the higher beta stocks, the higher moving stocks, the tech stocks, your banks, that sort of thing, much more faster. So when risk perception changes, you would generally see a switch. For example, from risk off to risk on, you would generally see selling of bonds and gold would fall and stocks to rise. So we're taking risk. So risk on, we're putting risk onto our portfolio, and when we move from risk on to risk off, we're going to take risk off our portfolio, which would generally lead to a fall in stocks and a rise in bonds and a rise in the gold market as well, which is basically what we're seeing right now following the tensions of the Middle East. Now, the action doesn't just stop with this podcast, and I'm hosting some live events this week where you'll actually get to learn one of our strategies and learn the 3 core rules for my favourite trading strategy called the sniper strategy, one that I continue to use every single day. So if you want to learn that, then please register for my next live and online trading event by heading to, bit of a weird link this one, so bit.ly, so bit.ly/learnts. So bit.ly/learnts. You can register and book yourself in for a free place on my next live trading event. And also, if you want to be kept informed about our up-to-date podcast, which we do weekly here, so myself and Jerry, you heard from earlier, then please make sure you register on one of these places. You can watch and listen on YouTube, you can listen on Spotify, you can listen on SoundCloud, you can listen on iTunes, or you can go to our website on trend-signal.com/trendsignal-blog. Cool, that's a bit of a mouthful. trend-signal.com/trendsignal-blog, and then you can go on and watch it as soon as it's updated. That's where priority access will be given. So we'd love to see you online, and if you've got any questions, anything you'd like us to cover off on in future podcasts, we would welcome your feedback. So please send an email to info@trend-signal.com with podcast in the subject line. That'd be fantastic. Have a great week, guys, and catch you next time.